In March 2026, a United States senator sent a letter to the CEO of the company that controls almost every mortgage approval in America. The letter wasn't a compliment. It was the opening of a federal investigation. The company is called FICO, and for nearly 3 decades, if you wanted a mortgage backed by Fannie Mae or Freddie Mac, which is most mortgages in this country, your lender legally had to use FICO score. No competitor allowed. No alternative accepted. That exclusivity let FICO do something almost no company in a competitive market could get away with. In a single year, they doubled their price, $4.95 per score in 2025, $10 per score in 2026 for the exact same product. Multiply that across a mortgage industry. That pulls hundreds of millions of scores a year, and you get a number the senator's own office calculated, roughly $500 million in additional costs, landing directly on the shoulders of borrowers, especially first-time home buyers, many of whom pay for multiple credit checks and never even close on a home. Here's the part that should genuinely get your attention. This isn't really a story about one company's pricing. It's a visible crack in a much bigger shift, one where the 3-digit number that's quietly controlled your financial life since the 1950s is being replaced by something far less familiar and far more invasive. Banks are increasingly scanning something else entirely: your actual bank transactions, your spending patterns, your rent payments, your utility bills. Not a single summary number, a real-time, algorithmically read picture of exactly how money moves through your life. Right now, in 2026, roughly 25 million Americans are considered credit invisible or thin file under the old FICO-based system. People with income, with jobs, with the ability to repay a loan, who simply don't exist, to the traditional scoring model. The system built to measure trustworthiness is being investigated by the federal government at the exact same moment its replacement is already being built. In this video, we're breaking down what's actually replacing your credit score, who's building it, what it can see about you that FICO never could, and why regulators are racing to catch up before the technology gets too far ahead of the law. Welcome to the Wealth Compass. Your credit score isn't just outdated, it's being quietly replaced right now. To understand what's changing, you have to understand how much power one company actually built over the last several decades. The FICO score has existed since the late 1950s, but its real dominance came from a specific regulatory decision. For nearly 30 years, lenders selling mortgages to Fannie Mae and Freddie Mac were required to use FICO scores, and FICO scores only. That single rule turned a private company's scoring model into something closer to mandatory financial infrastructure. Today, FICO scores are used by roughly 90% of lenders in the mortgage market, an even larger share among first-time homebuyers specifically. With that kind of guaranteed market position, competing on price was never really necessary. According to Senator Hawley's own office, FICO's per score royalty on mortgage originations climbed from 60 cents to $10 over roughly 5 years, an increase of nearly 1,700%. The full cost to a borrower has grown even more dramatically once you count the entire report, not just FICO's cut. A standard tri-merge credit report that cost roughly $30 to $33 back in 2019 and 2020 now regularly runs well over $100 per applicant in 2026. And FICO collects its fee regardless of outcome, whether a borrower gets approved, gets denied, or walks away entirely. The royalty is already paid, which means, as the senator's letter bluntly put it, the company profits. from the unsuccessful efforts of aspiring homeowners just as much as the successful ones. This is the part almost nobody explains about the credit system. It was never purely a measurement of your financial trustworthiness. It was also a business built on top of a regulatory monopoly, one that, until very recently, had almost no incentive to improve, innovate, or compete. That protection just started cracking, and the crack came from an unexpected direction, a rival score finally getting through the door. In July 2025, the Federal Housing Finance Agency made a decision that had been delayed for years. It announced that Fannie Mae and Freddie Mac would begin accepting VantageScore 4.0 as an alternative to classic FICO. On paper, that sounds like a minor technical update. In practice, it was the first real crack in a scoring monopoly that had gone essentially unchallenged for 3 decades. VantageScore isn't controlled by FICO. It's independently managed, jointly backed by the 3 major credit bureaus, and it had to pass through the same FHFA validation process any mortgage score is required to clear. The response from FICO's side was immediate and telling. Rather than simply competing on accuracy, both companies entered what industry observers described as a genuine pricing war. Credit bureaus offering discounts to push lenders toward testing VantageScore, while FICO simultaneously raised its own prices and rolled out new direct purchase programs for resellers. That's when Senator Hawley stepped in. In March 2026, he opened a formal investigation into FICO's pricing practices, sending letters to both FICO's CEO and the Federal Trade Commission and pointing to a prior request he'd already made to the Department of Justice's Antitrust Division. His argument was direct. A company holding roughly 90% of a market protected for decades by regulatory exclusivity had no real justification for a pricing increase that outpaced inflation many times over. As of early 2026, VantageScore's practical rollout in the mortgage industry is still limited. Industry insiders describe it as not yet fully operational at scale, but the direction is now unmistakable. The scoring system that quietly controlled who could buy a home in America for 3 decades is facing real competition, real regulatory scrutiny, and real pressure to change all at the same time. And underneath that fight, over which 3-digit number wins, an entirely different approach to creditworthiness has already started taking over. While FICO and VantageScore fight over who owns the traditional scoring model, a growing number of lenders have quietly stopped using a single score at all. The approach is called cash flow underwriting, and instead of summarizing your financial life into one number, it analyzes the raw data directly: your actual bank account transactions, your income patterns, your rent and utility payment history, your real-time balances, over months at a time. The scale of this shift is already measurable. Upstart, one of the largest AI underwriting platforms, originated $11 billion in loans in its most recent fiscal year, up 86% from the year before, generating over $1 billion in revenue and turning its first meaningful profit. The core justification lenders give is inclusion. Roughly 25 million American adults are considered credit invisible or a thin file under the traditional bureau system. People with steady income and real financial obligations who simply don't generate enough traditional credit history to produce a usable score. Cash flow data can see them clearly, even when FICO effectively can't see them at all. Industry data backs up the accuracy argument too. AI-based credit models, built on alternative data, have shown 15 to 25% better predictive accuracy than traditional scoring in some studies, while simultaneously reducing default rates for lenders. But there's a genuine trade-off underneath the inclusion story. This system requires something FICO never did: direct algorithmic access to the granular details of your actual financial behavior, not a summary, but the transaction-level reality of how you live. The system that replaces a single opaque number isn't necessarily a simpler one. In some ways, it's a far more detailed one, trading a flawed but limited 3-digit score for a system that can see almost everything all the time. That trade-off is exactly what regulators have started scrambling to keep up with. Here's where this stops being a story about better technology and becomes a story about oversight, racing to catch up. The Consumer Financial Protection Bureau has been explicit on one point: existing fair lending laws, including the Equal Credit Opportunity Act, apply fully to AI-driven credit decisions. Lenders legally cannot use so-called black box underwriting models if those models prevent them from giving a borrower the specific, accurate reason they were denied. That single requirement, explainability, has become the central battleground of AI lending regulation in 2026. Internationally, the pressure is even more structured. The European Union's AI Act designates credit scoring systems as high risk, with new compliance rules taking full effect in August 2026, requiring continuous post-market monitoring of how these systems perform in the real world. Colorado passed its own AI accountability law, taking effect in June 2026, requiring that algorithmic lending decisions can be reconstructed and justified after the fact. There's also a fraud dimension almost nobody discusses. TransUnion has identified over $3 billion in synthetic identity exposure, fabricated identities built specifically to fool both old and new underwriting systems, much of which gets misclassified as ordinary credit losses rather than fraud, quietly distorting the very data these AI models learn from. So the honest picture in 2026 looks like this. The old system is under federal investigation for anti-competitive pricing. The new system offers real inclusion for millions of previously invisible borrowers, but requires a level of financial transparency no generation has had a hand over before. And the regulatory guardrails meant to govern all of it are still being built in real time on 2 different continents with different deadlines. Nobody involved, not FICO, not the AI lenders, not the regulators, has fully finished writing the rules yet. You're living through the transition, not after it. So what do you actually do with all of this? 3 things worth taking seriously. First, your bank account behavior now matters more than ever, even outside of a formal loan application. Under cash flow underwriting, consistent income deposits, healthy balance patterns, and on-time rent or utility payments increasingly function as a parallel credit history, one that traditional FICO scoring never captured at all. If you're building credit from scratch or repairing it, your actual bank behavior is no longer invisible to lenders, even if your credit file is thin. Second, don't assume a low or non-existent traditional credit score means you're in bank forever. If you're one of the roughly 25 million credit invisible Americans, cash flow-based lenders may already be able to see a financial picture the old system simply couldn't, worth researching before assuming a traditional bank will automatically say no. Third, pay attention to what you're authorizing as more lenders shift toward alternative data, the fine print around what financial information you're sharing and with whom matters more than it used to. The CFPB's explainability requirement exists specifically so you can ask a lender exactly why you were denied. Use that right. Ask the question. The three-digit score that's ruled American finance since the 1950s isn't disappearing overnight, but it's no longer the only system in the room, and for the first time in decades, it's being forced to prove it deserves a position it's held for so long. Whatever replaces it will know more about you than FICO ever could. The only real choice you have is whether you understand that shift before it fully arrives or after. If this changed how you think about your own financial data, subscribe to the Wealth Compass. We decode the systems nobody explains to you. One question before you go: would you rather be judged